Fresh signs of weakness in the tech industry, more rounds of sweeping job cuts and hiring freezes. Amazon shares lower as it pauses corporate hiring and in anticipation of an economic slowdown. In the ride-hailing space, also Lyft cutting 13% of employees, which amounts to roughly 680 workers. Now, it's the second round of cuts this year.
Big tech announcing a slew of layoffs this year as Amazon, Twitter, other companies that aren't necessarily big tech have announced that they're paring back their workforce, many more announcing that they are slowing hiring or freezing hiring for the time being.
Several things are happening this November. The midterm elections, the interest rates hike, falling crypto prices, and of course the massive layoffs that have riddled big tech companies. To help us make sense of it all is Chamath Palihapitiya, a billionaire and macro analyst. Our metrics show that most viewers are yet to be subscribed to the channel. Subscribe now and you'll always get top-notch content from finance gurus. Now that you've done that, let's listen to Mr. Chamath.
Take a very balanced view of what happened this week. You have to start, I think, with the Federal Reserve. And really what they said is rates will probably be higher than all of you think, and they'll be higher for longer than all of you want. And again, without debating whether, that's going to come to pass or not, the thing that you can do is you can build a little sensitivity model to understand the mathematical implication of it. And basically what it means is that the dollar that's right in front of you is now meaningfully more important than the dollar that's far, far away from you. So let's just assume that, the Fed funds rate goes to 5.5% or so, even 5. Let's go to the optimists and say it's only going to go to 5. Tech companies have to achieve 500 basis points above that minimum. So we all have to generate 10 to 11% returns for us to be on a risk-adjusted basis better than a government bond. The problem with that is all of a sudden, if you're trying to generate cash even 3 or 4 years from now, it's not worth that much. You need to generate dollars today. And so, they are really reprioritizing the value of short-term profits. And that's going to affect how companies get money, the cost of capital, so how much dilution you have to take. So I think this is what companies are now bearing down for. They're realizing, oh man, I need to get my cost structure way in line. It is way better now, just to think about this contrast. It's way better to grow at 20% and be profitable than it is to grow at 100% and burn money, because it's not clear where that second company is going to get the incremental dollars they need for growth. And that's just a mathematical realization when rates are 5%.
After the 2020 COVID-19 lockdown and business shutdowns, the following year saw a surge in hiring. Big tech companies were out on a hiring spree. Unemployment had risen to 13% during the lockdown, but by mid-2021, it had fallen to 4.2%, as millions of new jobs were created. According to the U.S. Bureau of Labor Statistics, the U.S. unemployment rate has gone up from 3.3% in September 2022 to 3.7% in October. This is despite the fact that 261,000 new jobs were added to the workforce in this same period. The problem is companies are laying off, and tech companies are leading in these layoffs. Lyft, a car ride-sharing service provider, is laying off 13% of its workforce. This seems bad, but the company has lost over 70% of its valuation this year alone, so the worst may still be coming. Meta just announced that thousands of its staff may be getting the boot soon. The company, which encompasses Facebook, Instagram, WhatsApp, and a host of others, has seen a loss of about 71% in valuation year 2. Stripe, which was the highest valued startup in the US at $95 billion, is also downsizing on staff. The startup CEO, Patrick Collision, announced that the company would have to let 14% of its staff go. Even Twitter, which had just recently been acquired by Elon Musk, laid off half of its 7,500 staff, but may reduce this number of retrenched staff in response to the backlash that followed the massive retrenchment in the company. The story is not good for any of the big tech companies so far. Chamath believes that they are operating under impossible conditions, and it's impossible for these companies to keep up. What is happening right now should come as no surprise, because unemployment usually follows high interest rates and quantitative tightening, as we have seen this year. Jerome Powell had warned back in August and again in September of the hardship that is to follow the Fed's actions as they try to bring inflation under control. The major expected effect was unemployment. Fortunately, unemployment has not risen as sharply as many experts had thought it would. The Fed expects that the unemployment rate may have to reach 4.4% before inflation is brought down to manageable levels of about 2%. But some experts do not agree. They think it would come at a cost much greater than the 4.4% projected before the Fed meets its mandate.
Take Coinbase versus Carvana, right? These are both businesses that issued convertible debt sort of right before things got very, very hard. And if you look at where their convertible debt trades, it's trading basically at an implied yield of about 12 or 13%, both companies. Now, one is probably, a legitimate bankruptcy risk, which is Carvana. That's what the market would think. Whereas the other one, I think it has a very fortified balance sheet and could weather the storm, Coinbase. But unfortunately, in a moment where, rates are, again, the risk-free rate goes to 5.5, our cost of capital to do business goes to 10 or 11. These guys have to pay 12 or 13%. My gosh, it's really, really dilutive to be in business right now. So it just goes to show you that you can stay public, but if you want to get incremental money to cover your burn, the only way you can do it without really, blowing up your cap table and doing a massive recap will be through convertible debt. But it has a huge overhang and you risk turning the keys over to the debt holders of the company. So the alternative for that business is to go into the hands of private equity and get out of the spotlight of these public markets. But private equity is very smart. And the thing that's happened to them is they can't raise debt, right? So what do you think they do? They just have to pay 50% less than what they would be willing to pay before because they have to write, 100% equity check. So there is no free lunch anymore, I think is the big point to point out anywhere in the market right now.
Chamath believes that Elon Musk has an advantage by taking Twitter private. The company was outright bought, and shareholders would receive $54.20 per share in the buyout. Twitter would be delisted from the stock exchange this month, and the company would be in Elon's full control. Public listed companies have to follow a lot of protocol and bureaucracy to operate, but Twitter would not be encumbered by these restraints. Chamath believes this would play a huge advantage for Elon Musk and Twitter as a company. At a time when the big tech companies are experiencing decreased patronage, dwindling stock valuations, decline in profits, this could be a time to reinvent how they operate. Elon Musk is positioned to be the one that would reinvent how tech companies operate because of the freedom of total control he has. What are your expectations for Twitter? Do you think Elon Musk would succeed in reinventing how such tech companies work? Leave a comment below after you've clicked the like and subscribe buttons.